Hi there, Mike Brady with Generosity Wealth Management, a comprehensive full-service financial services firm headquartered right here in Boulder, Colorado. Here for my end of September, first 3 quarters of the year review, and 1 quarter left in 2018. So if you were in 100% stock market index, you were very happy in January, but that first quarter was pretty painful because February and March took a nice downturn. Then you basically dug yourself out of the hole the second and the third quarter of this year. However, the reason why we have bonds and cash as a part of it in our asset categories, unmanaged bond indexes, things of that nature, is we create a portfolio so that it tempers the down. It unfortunately tempers the up as well. And so for this year, if you were 100% stock market index, unmanaged stock market index, you're pretty happy so far this year after being unhappy the first half of the year. The last couple of months, August and September, pretty much bailed out the year. If you are in a balanced portfolio, which is the most appropriate portfolio for most people, because it allows them to sleep better at night and stick with the plan. Because I've been doing this for 27 years, and one of the most important things as I see it is that you've got to find a plan that works for you and stick with it. I think of it as a weight loss, whether it's Jenny Craig or Weight Watchers, etc. Hey, they all have their pros and cons, but you got to find one and you got to stick to it. That stick-to-itiveness is going to determine your success. It's no different with the investment in your portfolio. So you got to reach your financial goals by keeping in control of your emotions and thinking long-term, not short-term. So you might ask yourself, okay, if I would have been happier in 100%, equities or stocks, why didn't I have all of that? Well, when the yield goes up, bonds in the short term have a tendency to decrease. However, that's not always the case. I'm going to put up on the screen a chart that shows when the yield is below 5%, which right now it's a little over 3%, 3.2%, over a 2-year time horizon, equities still have increased. Okay, so this is not a death knell, which is what if you would think if you read some of the news reports. That's just simply not the case. Look at this fixed and income interest rates, and you'll see that over 2015, 2016, 2017, rates are continuing to increase. And the stock market, unmanaged stock market indexes continue to increase. So there's not a correlation to the degree that you would think by reading all the news reports. Emerging markets helped in 2017. Last year was a very good year for balanced portfolios. Bonds added to it. Emerging markets added to it. This year, emerging markets, international markets, and bonds have decreased. So therefore, a balanced portfolio is not going to be anywhere close to where the Dow Jones or the NASDAQ or the S&P is, which are unmanaged stock market only indexes. When we look up on the screen, I've just put something up. On the left-hand side is how emerging markets did last year in 2017 and what they look like so far this year. 1 year it's adding to it, 1 year it's decreasing from it. Over multiple years, they have a tendency to kind of one zigs and one zags. And so that's the reason why you have different asset categories. I continue to be quite positive on the U.S. stock market in general. When you look at, just put a chart up there, when you look at the earnings per share, they continue to be good. The amount of money flow out there is good. Just trying to pull up my copy of the chart. You can see right there, and I've just circled it, the S&P earnings per share continue to be positive. This really bodes well. And so, you don't have a market correction just because of a certain age, just because it's been going for so many months. It's the characteristics that are inside the market, the various optimism, the various money flow, things of that nature that determine whether it's a healthy stock market or not. So I think that if we go back to the old fundamentals, which is stay diversified even when you would prefer to be undiversified. When you say, gosh, I wish I had it all in one asset category or another, or this doesn't comport with what I might see on TV. No, you stick with what you have and have a long-term vision, because my experience has been that many investors make short-term decisions based on a long-term financial goal. That just doesn't make sense. If you did that with a boat, you'd be zigzagging all over the place. Why do that with your financial future? So I have no reason to be concerned for the rest of the year as I throw the tea leaves in the water and read them. And so I will continue with my clients full steam ahead what we have already. Mike Brady, Generosity Wealth Management, comprehensive full-service financial firm here in Boulder, Colorado, 303-747-6455. Thank you. Bye-bye.